The financial landscape we've been living in for the past few years has officially changed. For the longest time, we saw unprecedented growth fueled by record low interest rates, easy borrowing, and a wave of optimism that seemed unstoppable. People believed the market could only move in one direction, up. But here's the truth: markets don't move in a straight line forever. They move in cycles. And what we're experiencing right now is not a minor shift. It's a flip. This isn't about doom and gloom, and it's not about pretending the good times are over. It's about understanding what happens when the factors that once fueled growth suddenly start working in reverse. Investment. Interest rates that were once near zero are now pressing on the brakes. Housing affordability, once stretched to its limits, is pulling buyers back. And consumer behavior, shaped by years of optimism, is now facing the reality of tighter budgets and tougher decisions. That combination is creating the exact scenario we're seeing unfold: a flipped market. Now, when people hear the word flip, they often assume disaster, but this isn't about collapse, it's about correction. Think of it as gravity finally pulling us back down to earth. Prices that soared far beyond fundamentals are being tested. The demand that once seemed endless is slowing, and investors who bought in without strategy are starting to feel the pressure. But here's the other side of the story: whenever a market flips, opportunities emerge for those who pay attention. This is where history becomes a teacher. Every cycle brings a group of people who panic, sell too quickly, or freeze out of fear. But it also brings a group of people who stay calm, do their homework, and take calculated risks. Investment. The difference between these two groups will determine who thrives in this new environment and who gets left behind. The market flip is not a signal to give up. It's a signal to get smarter. Timing matters more now than it has in years. That means asking the right questions. When do you buy? When do you wait? What signals should you trust? And which ones are just noise? If you can answer these, you can not only protect yourself, but also position yourself to take advantage of the opportunities hidden within this flip. So if the last few years were defined by speed, urgency, and bidding wars, this new chapter is defined by strategy, patience, and precision. The rules have changed, and if you don't adapt, you risk falling behind. But if you do, you might find that this flip, while unsettling on the surface, could be the very moment that sets you up for the best financial opportunities of the decade. For the past several years, the housing and financial markets have been running on adrenaline record. Low interest rates, cheap borrowing, and unprecedented demand created a sense of invincibility. It felt like the rules of the game had changed forever. Like homes would only go up in price, stocks would continue climbing, and money would always be easy to access. But here's the thing about markets. Investment, they have a way of reminding us that fundamentals still matter. What we're seeing now is not just a small adjustment, it's a full shift in sentiment, a collective change in how people think and feel about money, investing, and opportunity. Investment. Let's start with housing because it's one of the clearest examples of how sentiment drives behavior. 2 years ago, buyers were scrambling to lock in homes at historically low mortgage rates. Bidding wars were the norm. Offers went tens of thousands above asking price, and sellers could practically name their terms. The emotional fuel was fear of missing out. People believed prices would never come down, and if they didn't buy now, they'd be permanently priced out. That mindset pushed prices far beyond what fundamentals like income, affordability, and long-term sustainability could support. Fast forward to today, and the psychology has flipped. Interest rates are no longer at record lows. They're several points higher. That shift alone means a home that cost, say, $400,000 2 years ago with a 3% mortgage rate might now require hundreds more per month in payments at 6% or 7%. The monthly payment shock is massive, and it's changing how buyers think. Suddenly, the conversation is no longer about how high over asking do I need to go, but instead, can I even afford this at all? That change in thought, from fear of missing out to fear of overpaying, is the essence of a sentiment flip. And it's not just housing. Stock markets and broader investment strategies are experiencing similar shifts. When money was cheap, investors took bigger risks. Tech startups, speculative stocks, and even cryptocurrency soared because the collective belief was that growth would continue indefinitely. Today, with borrowing costs higher and risk tolerance lower, that enthusiasm is cooling. People are moving their money into safer, more stable assets. The very same investment that looked like a golden ticket 2 years ago now feels like a liability. This is why market sentiment matters so much. It dictates behavior. When people feel optimistic, they spend more, borrow more, and take more risks. When they feel cautious, they pull back, save, and wait on the sidelines. The numbers may not change overnight, but the mindset does. Investment. And that mindset eventually drives prices, demand, and opportunity. What makes this moment so unique is that we're watching a generation of buyers, sellers, and investors experience their first major market reversal. For many, investment, the past decade has only been about growth and optimism. The current shift feels uncomfortable, even unfair, because it's a stark reminder that markets are cyclical. It's human nature to assume the future will look like the recent past. But now the past few years are giving way to something very different. This change in sentiment is powerful because once it takes hold, it spreads. When neighbors stop talking about how much their home values skyrocketed and start sharing stories of price cuts or unsold listings, it reinforces the new mindset. When investors see their riskier bets underperforming, they talk about pulling back, which influences others to do the same. That cycle creates momentum, just like the upward momentum we saw before, but now in reverse. Ultimately, this shift isn't about numbers alone. It's about psychology. The market flip we're experiencing begins in the minds of buyers, sellers, and investors. Once confidence changes, behavior follows. And once behavior changes, the market itself transforms. What used to be optimism has become hesitation, and that hesitation is rewriting the rules for how the next phase of this cycle will play out. Whenever the market flips, the natural reaction is fear. Headlines scream about declining prices, investors worry about losses, and buyers hesitate, unsure if they should jump in or stay on the sidelines. But here's the thing, what feels like chaos to most people is actually a prime opportunity for those who can think strategically and stay calm. Market flips are rarely evenly distributed. They create winners and losers, and often the biggest gains come from those who see opportunity where others see panic. Let's start with real estate because it's one of the clearest examples. When prices start to slow, some homeowners panic and put their properties on the market at discounts. This isn't just a chance to buy a home for less than what it was worth a few months ago. It's a chance to get long-term appreciation potential at a fraction of the previous cost. The trick is understanding which properties are likely to hold value and which are truly overpriced, because chaos creates both risk and reward. People who study the fundamentals, location, supply and demand trends, neighborhood growth, and interest rate effects can identify opportunities that others overlook. The same principle applies to investing. In a market that flips from optimism to caution, volatility spikes. Prices that were once inflated by hype now pull back. Stocks, ETFs, and other investment vehicles often experience temporary dips that don't reflect the underlying value. Smart investors recognize these dips as buying windows. They understand that panic-driven selling is rarely rational and that those who remain patient can acquire high-quality assets at discounted prices. In other words, chaos amplifies opportunity if you know where to look. But it's not just about buying, it's also about positioning yourself strategically. In a flipped market, cash becomes king. People with liquidity can negotiate better deals, invest in distressed assets, or take advantage of low competition in auctions and foreclosures. Those who rely solely on credit or are over-leveraged tend to struggle when rates rise, while those who plan ahead can capitalize on moves that would be impossible in a more stable market. Understanding where the leverage points exist, both literally and figuratively, allows you to turn uncertainty into advantage. Another opportunity lies in adaptability. Markets that flip create winners for those who pivot quickly, sellers who adjust expectations, investors who diversify, and buyers who understand market timing gain an edge over those who cling to outdated strategies. Flexibility becomes a competitive advantage. For example, in real estate, a landlord who adjusts rent pricing to match market demand retains tenants and cash flow, while one who ignores the shift risks vacancies. In investing, reallocating portfolios to reflect the new economic reality can protect capital and even yield outsized returns. Finally, the chaos itself is a teacher. Observing how people react, which sectors slow down, and which ones thrive gives insight into the future of the market. Every flip brings clarity. It separates speculation from fundamentals, hype from reality, and short-term greed from long-term strategy. Those who pay attention to these lessons not only survive the current flip, they're positioned to dominate the next cycle. In short, what feels like disruption is actually a launch pad. The market flip exposes weaknesses in unprepared participants, but it also hands an opportunity to those who think critically, act strategically, and remain calm under pressure. Chaos doesn't destroy wealth. It redistributes it, often rewarding the observant, disciplined, and patient. Recognizing that opportunity is the first step toward turning a market flip from a source of anxiety into a source of potential growth. When a market flips, it's easy to think of the event as a monolithic wave that affects everyone equally. But the reality is far more nuanced. Every market cycle has its winners and losers, and understanding who falls into each category can make the difference between financial survival and financial opportunity. The flip doesn't just reshape prices. It reshapes behavior, priorities, and strategy, revealing who adapts and who resists. Let's start with the obvious, the losers. These are the people who fail to recognize the shift and try to cling to the old rules. In real estate, these might be buyers who continue bidding aggressively without adjusting for rising interest rates, or sellers who overprice their homes, hoping the boom will return instantly. In investing, these are the individuals who bought into hype, chasing momentum without understanding fundamentals, and now find themselves facing sudden losses or stagnation. The common thread among losers is rigidity. They treat the market like it owes them, rather than adjusting to its new reality. Investment. Another type of loser is the overly leveraged participant. Debt magnifies gains in a rising market, but it magnifies losses when sentiment flips. Homeowners with large mortgages, investors with borrowed capital, and businesses relying on cheap credit all feel the pain as interest rates climb and cash flow tightens. These participants often panic, selling at a loss or defaulting on obligations, reinforcing the market flip as they exit the system. Their mistakes are teachable moments for anyone watching. Leverage without strategy is a double-edged sword. Now let's focus on the winners, because this is where opportunity meets preparation. Winners are those who recognize the flip early and adjust their strategy accordingly. In real estate, this could mean buyers waiting patiently with pre-approved financing, ready to act when motivated sellers reduce prices. Investors who diversify portfolios, hedge risk, and focus on long-term value rather than short-term hype are positioned to benefit from volatility. But the defining trait of winners is adaptability. They see the market not as a threat, but as a system that responds predictably to shifts in supply, demand, and psychology. Timing is another key factor that separates winners from losers. But those who move too slowly often miss critical opportunities, while those who act too quickly without understanding fundamentals can overcommit to bad decisions. Winners strike a balance. They understand when to wait, when to negotiate, and when to pull the trigger. This isn't luck. It's disciplined observation combined with strategic action. The flip also creates winners among those who leverage information better than others. Knowledge becomes a competitive advantage, and understanding local real estate trends, consumer behavior, or economic indicators allows some participants to anticipate the next move before it becomes obvious to the market at large. While many are reacting emotionally, investment winners are reacting intelligently, turning insight into tangible results. Finally, winners capitalize on mindset. While losers panic and blame the system, winners remain patient, disciplined, and forward-looking. They know that cycles are temporary and that the market flip is part of a long-term story. Their ability to stay calm under pressure allows them to make rational, high-value decisions, while the panicked sell-offs of others create space for opportunity. In essence, the market flip isn't about doom or collapse. It's about separation. It separates speculation from fundamentals, panic from discipline, and reaction from strategy. Those who adapt and think strategically will emerge stronger, with opportunities that a static or fearful participant could never access. In the end, the winners of the flip are not the luckiest. They are the most prepared, observant, and adaptable. If there's one lesson every investor, buyer, and seller must take away from a market flip, it's this: timing has never been more critical. In a rising market, people often get away with hasty decisions. Buy now, prices go up tomorrow, and you're safe. But in a flipped market, every move carries amplified consequences. Acting too early, too late, investment, or without a clear plan can turn what looked like opportunity into a costly mistake. Timing, more than luck or instinct, determines who thrives and who struggles. Let's break it down with an example from real estate. Imagine a neighborhood where homes were skyrocketing in value for years. During the boom, buyers didn't hesitate. They made offers quickly, sometimes overpaying just to secure a property. Now the market has flipped, interest rates are higher, prices are plateauing, and demand is cooling. A buyer who jumps in immediately, without assessing affordability or local trends, risk overpaying. Meanwhile, a buyer who waits too long may miss motivated sellers, reducing prices to realistic levels. The sweet spot, the moment when price, demand, and financing align, is where timing matters most. It's the same principle in investing. Stocks and other assets react not just to fundamentals, but to sentiment. During a flip, a good investment panic often drives temporary price swings that don't reflect true value. The investor who acts impulsively during a dip may buy too early, catching a falling knife. The investor who hesitates too long may miss the rebound entirely. Investment timing in this environment requires patience, observation, and a strategy informed by both data and psychology. It's about understanding when the market is overreacting and when it's stabilizing, and positioning yourself accordingly. Another reason timing matters more than ever is the speed at which information travels. In the past, market corrections unfolded slowly, giving people time to react. Today, social media, financial news, and real-time analytics amplify every fluctuation. Sentiment can shift overnight, creating opportunities or pitfalls at lightning speed. Those who monitor trends carefully while staying disciplined can make moves ahead of the crowd. And those who chase headlines or follow herd behavior often find themselves on the losing side. Cash flow and liquidity also intersect with timing. In a flip market, buyers with ready cash or pre-approved financing can act quickly when opportunity strikes, while others remain stuck in approval processes or limited by credit. Similarly, investment. Sellers who understand when to list a property for maximum exposure benefit from better timing, while those who wait too long may see their window close. Timing isn't just about market trends. It's about your personal ability to act decisively when conditions are favorable. Finally, timing matters because the flip magnifies risk and reward. Every decision carries greater consequences than it did in a booming market. A poorly timed purchase can result in months or years of negative equity. A perfectly timed move, however, can set you up for significant long-term gains. The difference between the two often comes down to preparation, observation, and a willingness to act when the moment is right. In short, a flipped market punishes indecision and rewards strategy. Understanding the rhythm of the market, the signals of opportunity, and the psychology of buyers and sellers allows you to align your actions with the optimal moment. In this environment, timing isn't just important, it's the single factor that separates those who emerge stronger from those who get left behind.